US markets essentially got confirmation on Friday that rate cuts are coming in September. Our guest says, sure, those cuts are coming, but Jay Powell, the Fed chief, is leaving the door open, as to cut size, as the amount of reduction that he's thinking about. And the argument here is that the recession probability has risen, but the soft landing is the most likely case. Let's bring in Gary Schlossberg, global strategist at Wells Fargo Investment Institute. Thanks very much for coming on the show.
Thanks for having me.
So your take is, I mean, you're in the camp, just about everybody is, that a cut is coming. But could Powell cut 50 basis points?
It's possible. We still have an employment report that's due out before that meeting on September 18th. If that employment report is soft enough, that could set the tone for that FOMC meeting, leaving the door open to a 50 basis point cut.
Would that be an admission by Powell that they've been too slow to bring down borrowing costs, or am I just reading too much into it?
Well, cuts of more than 25 basis points are often interpreted by the market as an admission that the Fed has fallen behind the curve, or something's going on that the market isn't aware of. So to your point, the Fed is going to deliberate very carefully. We think the odds are for a 25 basis point cut. But coming atop a soft employment report for July that came out in early August, if we do get another soft one, there is certainly the possibility that the Fed will cut by a half percentage point.
And so the base case, to use that expression, is that America doesn't go into a recession.
Yes, we're still looking for a mild to moderate economic slowdown, something of a soft landing before the economy begins a moderate growth recovery in 2025.
Employment and wage growth normalizing, because that was stubborn, wasn't it? The labor market stayed hot for quite a long time.
It is losing momentum. We don't expect to see the kinds of declines in jobs that we would see during a recession, for example. But we don't have that tailwind from that post-COVID catch-up hiring that helped keep the economy resilient over the past couple of years. But to your point, things will hold up well enough between that, the decline in inflation, setting the stage for rate cuts by the Federal Reserve, financial conditions hopefully will remain accommodative, and that will set the tone for a soft landing in 2024 and 2025.
You think people who have money parked in short-term income funds, which aren't too vulnerable even to rate moves, should think about moving into equities now?
Yes, we do. We think that short and intermediate securities are less favorable than they were a few months ago. We are favoring a rotation into equities ahead of that growth recovery that we expect to see next year. Staying with quality, however, our focus continues to be on large cap stocks. We have upped small caps to a neutral position. But really the focus continues to be on balance sheet strength, tradability, liquidity in that large cap segment of the market.
What sectors do you think are undervalued right now? Does anything leap to mind?
Well, we think that as the economy recovers next year, we are looking at some of the more economically sensitive sectors of the market, viewing them a bit more favorably. Industrials, materials, financial services. And then beyond that, we think there are opportunities in communication services benefiting from artificial intelligence. And the energy market, we think, will remain intact enough for a neutral to favorable position next year.
Do you think we'll look back a decade from now? I mean, you and I will be a little bit older then, and will we say, gosh, we were crazy to be paying those multiples for big techs?
Well, I think there is that inevitable rush into a new technology. Artificial intelligence does have the ability to be a game changer down the road. And typically, when you see these technological changes with the opportunities created, you do tend to get that rush into the market. Valuations may be a bit extreme. They may settle back a bit. But if we're right about the longer term opportunities for artificial intelligence, digitalization, we think the market, in taking that longer view, ultimately will be proven to be correct.
What about the election? We heard a lot about the Trump trade when Mr. Biden was seen as a weak candidate. Now Kamala Harris is the standard bearer for the Republicans. Some investors had been betting on higher inflation under Mr. Trump, partly because he's keen on tariffs. Is the election a big factor in people's decision making right now?
I don't know that it's a big factor just yet. It could create some uncertainty. Investors may position for what they think the policy changes will be next year. Our view is that investors should look through potential changes resulting from the election, potential political changes to the longer-term policy outlook. For one thing, there are intra-party differences out there. There are legislative hurdles, a 60-vote majority needed in the Senate to pass legislation there. Other economic policy issues, the debt ceiling, the allocations to the fiscal 26 budget, tax reform, the current tax bill will expire at the end of next year. These things will make it difficult for any new administration, whether it's a unified government or a split government, to implement policies that have been advocated during the election.
You actually reminded me of something there, Gary. Maybe we could put up a 5-year chart for the US dollar. It certainly has been weak. And even the British pound is at a 2-year high against the US currency. Well, maybe people are optimistic about the new Labour government. But why has the US dollar been weak, do you think?
Well, we think a lot of it has to do with the outlook for interest rates. There is some talk that the Federal Reserve will be a bit more aggressive in rate cuts than, say, the European Central Bank, a couple of the other central banks in major industrialized countries. And the economy has lost a little bit of momentum as well. So when you marry those two with the election year uncertainties, perhaps that's contributed to the dollar's decline. But I think interest rates have really been the main driver behind the dollar's weakness over the past couple of weeks.